morning, everybody. It's Chris here from Serene Education with the 4 majors notes update for the 25th of June 2013. Morning, guys. Okay, I'm just going to go with the 4 majors, starting with the euro against US dollar using our FX8 template, with the one you can see down the bottom right in here. And I just want to bring to your attention the weekly chart. I should have done this on Monday, to be honest with you. However, I just want to give you an indication of what happened last week in comparison to what price has been doing previously at this particular point. And you can quite clearly see, take an all-time high in 2011, this extension to the downside we saw before we saw this correction this year in May, or last year May, apologies. And you can see the fib retracement acting quite nicely here, where prices actually consolidated along the way. But you'll notice the major one over here had the 50% retracement, which also concurs quite nicely with the 200 period moving average. And you can see the last time we attempted the institution moving average, we actually had a very nice break above the 50% retracement at the same time. However, the following week that preceded, we failed to see price actually hanging on to those levels, those highs, and then kicking onto the upside. We had a failure here not too long ago in February of 2012. So here again, last week's bearish sentiment at this major support and resistance at this fib level of here didn't bode well for overall sentiment, and it pushed price below the 38.2. So now if this is to be a genuine bearish engulfing candle at a major resistance level, then we need to see the 38.2 now acting as a ceiling level for our daily, for our hourly, etc. So if I go to my daily chart, you can see that price has bounced off the institution moving average on the daily, which also is the 50 period moving average. RMO is still above the zero line, however has pulled back to that zero line. MACD is very much negative, so telling us it's very sharp selling to the downside. It needs to maintain below the 38.2 now if this is to be a genuine, to follow up with last week's genuine bearish engulfing candle. And you can see on the 4 hour finding resistance here over the past 20 hours or so. So it's imperative, if this is still to remain negative, that the 38.2 needs to maintain above price for the foreseeable future. At least this week, if we get a nice bearish engulfing candle closed lower, i.e. on our, particularly on our 4 hour, getting below the institution moving average right here, then we should see ultimately price moving lower. Failure to see that happen and we get this 38.2 being breached, then obviously we should be looking for a potential further pullback. And if that's the case, we can take the all-time higher, for example, down to the current low, the spinning top low that we've had just recently. See there the 23.6 is right now, which also complements the 38.2. Get above that, then we can target these particular retracement areas to the upside to where we've just come from. So imperative, if this is to be a genuine negative bearish engulfing week, we need to see if further sentiment to the downside, and doing so spending more time below the 38.2. And if we do see that, then we should see a bearish engulfing candle continuation lower. Failure to do so, and we see price hanging around the 38.2, then ultimately we could see a potential bounce to the upside. Let's have a look at sterling for the same time. Okay, so you can see here again, like its European counterpart, a huge bearish engulfing candle, and here again also coming at the institution moving average. The last time we were above the institution moving average was the 6th of January of this year, and you can see the major fall to the downside. We are, however, still above the 23.6 on our monthly fib, which is this red line, which is a good positive sign because we're making higher highs. If it got below that, you can see there's a major support level over here. If we get above that and we remain above this 22.6, there's always going to be a likelihood for price to move to the upside. But this bearish engulfing candle didn't do much to actually help sentiment, and you can see that we're consolidating now, but it's still above the 23.6. So very, very important. As long as it maintains above 23.6, then ultimately we should be looking for a potential bounce back towards the moving average on our daily, and then reattempt of the highs we've seen here at the 61.8 at 1577.50. So if that bearish engulfing candle was genuine negative sentiment last week, we would need to see the 23.6 here on our week, this monthly retracement of here, February retracement being breached as soon as possible. Failure to do so, we're just going to see a correction, and that correction is going to reattempt the highs that we just come from. US dollar Swiss franc, look at the weekly here again, also failing at a 61.8, but also failing to get above that institution moving average now. We've had a huge correction since 2011. However, price has pretty much not made any higher highs or reattempted higher highs, and in doing so correlate or consolidating roughly around this 38.2, or trading within consolidative range, and it's no difference over here. We had a reattempt of the institution just recently, however, shooting stars, exhaustion candles at this level here, and price was reverted down to over the past month or so. Most important one, actually taking a breather here at the 23.6, not making lower lows. Last week's bullish engulfing candle has formed a support, and you can see that price is failing under the 50% monthly retracement. So here again, if this is to be serious upside movement of this consolidation here, we would need to see the 50% mark, 50% retracement actually being breached, and that also concurs. You can see we have both our institution and our 20-period moving average all working together here. A lot of resistance at the moment, a lot of hesitation. You can see all the moving averages not really much giving us any indication of pure trends, and you can see what price has been doing. It's just been consolidating. The R squared in particular, flat, red across the board, so no true sentiment across the board in any which way, and hence the reason why price is just stagnant. So ideally, if we are going to see further negativity, leading on from what we saw after the US Fed announced tapering on the QE3 plan, then we need to see the 50% fib retracement acting as a ceiling level. Otherwise, if this is to be a genuine consolidation here, and this is looking for topside favorite, then we need to see a break of 50% and close higher for the remainder of this week. So here again, in no man's land, not really going anywhere. Want to see either one or two things: breaking lower than this 92115, these current support levels to the downside, or breaking higher than the 50% retracement here above the 9384 mark, and then we could look to the top side. Weekly on the yen, here again, a lot of negativity of the past month. However, last week's candle engulfing the prior week's candle. So effectively, this could be a tweezer bottom. Is it a tweezer bottom? Well, if you're going to see any further buying coming through for the US dollar against the yen, we would need to see price maintaining above the 23.6 fib retracement here. So we've taken the all-time low that we saw in October through 2011 to the current high that we saw after this progression to the upside through April of this year. And you can see the 23.6 has been a price support and resistance level, support and resistance. Price has been playing tic-tac-toe with it, and in doing so, forming a tweezer bottom. Railway tracks, one engulfing the other. However, as it stands now, if I go to my daily, that 23.6 needs to be near-term support. If this is a genuine tweezer bottom after a small downtrend, we would need to see price actually moving higher, and 23.6 would need to be the current intraday support. 97,185 needs to remain below price for the remainder of this week. Failure to do so, we're going to see prices falling back towards that 38.2, back towards that tweezer bottom. So on our 4-hour chart, here we go. You can see the candles have been blue on our 4-hour, but you can see quite clearly institution is still governing price in our intraday time frames. We haven't been below the institution since May, and we are still trading below it, and also below the major 50% retracement. So imperative to see price hanging on to these highs here and using the 23.6 at 96.80 as its support intraday for the remainder of this week. Failure to do so, we should see negativity coming back into play again, and that's going to force price lower. So use it as a guide stick. Put a horizontal trigger line here. If price closes below the 23.6, look to the downside. The longer she spends above 23.6 fib, look to the top side, back towards the institution, back towards that 100, back towards a 50% retracement. That's it, guys. Short and sweet. Please, if you're using this template, please back it up with sound money management rules. Follow the rules of the template, guys, and keep it as simple as possible. Be aware of your weekly support and resistance levels, and use those as guidelines or target limits, or show where prices are trading within that range. If it's trading quite close to it, don't risk the opportunity of trading into a major support and resistance level, because you're going to put that much more risk in your favor and you're not going to get a return. So rather wait for a genuine break above or below that particular point. Is it moving in the direction of the long-term trend? If it is, then look to re-enter at a later stage. Other than that, have a fantastic trading day, and I'll see you guys first thing tomorrow morning. Until then, you trade serenely.